Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. Welcome to another edition of our weekly podcast. Global equities trended mixed over the past week, with developed market equities gaining marginally as labor data from the US added to optimism that the economy is gliding towards a soft landing, while bond yields edged higher. Asian equities remained under pressure, dragged by Chinese and Hong Kong markets. During the week, Moody's lowered China's credit outlook from stable to negative and cut the outlook for Hong Kong, Chinese banks, and local government financing vehicles. For the week, the MSCI Asia ex-Japan and MSCI China fell between 0.7 to 3.6%, while the MSCI World Index rose 0.2%. In the US, the Dow Jones Industrial Average, S&P 500 and Nasdaq Composite Index traded closer to YTD highs, up around 0.1% to 0.7% over the past week. Back home, Indian equities continued to gain for the sixth consecutive week. The Nifty index gained 3.5% for the week and touched a new all-time high, driven by upbeat domestic growth, state election results, status quo on RBI monetary policy announcement, and robust foreign investor inflows. Broader markets underperformed Nifty this week, with the Nifty Mid-Cap Index up 2.3%, while the Nifty Small-Cap Index was up 1.2% for the week. Among sectors, most sectors ended the week in green, with utilities, energy and banks leading the winners with gains of over 5% for the week, while pharma, FMCG and telecom posted marginal declines. The Indian fixed income market had a good week, with Indian government bond yields declining across the curve. After starting the week with a downward bias, bond yields rose later in the week after the RBI indicated a data-dependent cautious stance, with policy rate cuts likely some time away, and the cut-off yields at the weekly government debt auction coming in higher than expected. For the week, the 10-year Indian government bond yield fell 2 basis points to close at 7.27%, while the 3-year and 5-year government bond yields fell by 4 basis points and 2 basis points respectively. The INR fell marginally over the past week to close at 83.39 per dollar, as the impact of lower crude oil and foreign investor inflows were negated by rising US bond yields and stronger US dollar. Brent crude oil fell to a 6-month low as investors remain worried about sluggish energy demand in the US and China, while data showed output from the US remains near record highs. Among the major macro updates, the first was on India's services PMI, which declined to 56.9 in November of 2023 from 58.4 last month and below market forecasts of 58. The moderation was driven by a softening in new orders and output, with new export orders rising the least in 5 months. Employment continued to increase despite the rate of job creation being slow. On the pricing front, input price inflation slowed to an 8-month low, while output cost inflation also eased to the weakest since March. Lastly, business sentiment remained positive, although confidence somewhat faded due to rising inflation expectations. The second update was an RBI's Monetary Policy Committee meeting for December 2023. The key takeaways include: in a unanimous decision, the RBI left the repo rate unchanged at 6.5%, and with a 5:1 majority, it maintained its policy stance as withdrawal of accommodation. The RBI noted that domestic growth remained resilient, aided by robust manufacturing, buoyant PMIs, strong government capex and healthy GST collections. Accordingly, the RBI raised its fiscal year 2024 GDP growth forecast up to 7% from 6.5% earlier. The RBI noted that CPI inflation decelerated significantly, with disinflation across categories and a broad-based easing of core inflation. It further indicated that inflation outlook would be influenced by uncertain food prices, and while the MPC would look through such one-off shocks, it will remain alert to the risk of such shocks being generalized. Accordingly, the RBI did not change its inflation projection for fiscal year 2024, which continues to remain at 5.4%. The RBI further noted that headwinds from geopolitical turmoil, volatility in global financial markets, and global economic slowdown pose risks to this outlook. Additionally, the RBI noted that deficit liquidity conditions during September to November have not warranted OMO sales so far. However, the MPC will remain nimble on liquidity management and keep it neutral. At this point, I'll take a pause and thank you as always for listening. If you enjoyed this podcast, please like and subscribe. Have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.